China slows the flow of rare earths. The US fires back with new tech bans. Wall Street shrugs it off until the dollar starts to slide. Not a dip. Descent. 5 months straight. This isn't about tariffs anymore. It's about something deeper. In May, the US quietly triggers a global panic. Not with bombs, not with speeches, but with a spreadsheet. A threat buried in tax code. A ripple that tears through trade talks. American banks left holding bonds nobody wants. Allies behind closed doors are cashing out. Trump calls it strategy. Markets call it a crisis in motion. So now what breaks first? Trade, trust, or the system holding it all together? Trump takes the stage and claims victory. Says he saved China from collapse. Civil unrest, factory closures, chaos, but no evidence. Bloomberg says the opposite. China's industrial output's actually up 6.2% in April. Still, a 90-day truce gets brokered in Geneva. US tariffs fall to 30%. China's dropped to 10%. But while diplomats shake hands, the Commerce Department drops a hammer, cutting off China from chip design tools and crucial chemical exports. Reuters confirms even licenses that had already been approved were suddenly pulled. Washington calls it containment. Beijing calls it sabotage, silently, strategically. Was this about de-escalation, or was the rescue always a setup? Treasury Secretary Scott Bent scrambles to Switzerland, trying to keep the market from cracking open. He patches together a fragile deal, freezes $145 billion in tariffs. But Beijing barely reacts. CNBC reports China hasn't lifted rare earth restrictions or sped up export licensing, despite its Geneva promise. U.S. Trade Rep Jamieson Greer says critical minerals still aren't moving. China's Ministry of Commerce claims due process, security reviews. But this isn't red tape, it's leverage. Calculated silence. Washington blinks. Beijing doesn't. On Wall Street, the whole thing's become a joke with a payout. Traders call it the takeoff strategy. Trump threatens tariffs, stocks tank, then rally when he backs down. On May 2nd, the Financial Times coins it. May 28th, it plays out again. Trump delays a crushing tariff on European imports, and the S&P jumps 2.1%. Investors are getting used to the pattern. But Moody's isn't laughing. They downgrade the U.S. credit outlook, citing rising fiscal chaos. And here's the twist. What happens if Trump doesn't fold this time? What if he breaks the pattern? Markets built on reversals suddenly have no safety net. This isn't just a game of numbers anymore. It's about trust, about whether Washington still plays by any rules at all. Then the numbers start to fracture. April trade data doesn't soften, it implodes. U.S. goods imports drop nearly 20% in a month, the biggest collapse on record, right after March's so-called Liberation Day tariffs. Consumer spending, nearly 70% of U.S. GDP, slows to a crawl. Just 0.1% growth in April, down from 0.7% the month before. People aren't buying, they're burning through stockpiles. Prices are up. Confidence is down. The tariffs meant to punish China are gutting domestic demand. And with exports falling too, the engine that powers America's trade liquidity is stalling. The weapon's firing in reverse. Since December, the dollar index has dropped almost 5%. Bloomberg says June marks the 5th straight month of decline. That's not volatility. That's erosion. The Institute of International Finance puts foreign holdings of U.S. assets, mostly Asian, at over 7.5 trillion. Built over decades. Built on trust, on trade, on predictability. But now, with wild treasury swings and chaotic fiscal messaging, even the most stable foreign investors are watching the exits. Yes, a weaker dollar boosts exports, but only if the world still believes in the system behind it. And right now, that belief is cracking. Exports are collapsing. Consumer spending is flatlining. But that's just the surface. What's happening beneath is something far more dangerous. The slow, quiet cracking of the story that has held the global financial system together for over 70 years. The threat isn't just capital outflows anymore. It's narrative collapse. And if the dollar stops being seen as the world's safest asset, the architecture built around that belief doesn't just shake. It starts to fall. Think of it like this. The U.S. economy has long depended on something more fragile than money. Trust. Trust in its markets, in its stability, in its political consistency. That trust has let America run deficits no other country could get away with. It has allowed Washington to spend freely, borrow endlessly, and still draw the world's capital. But what happens when the world starts quietly, cautiously, saying no? Treasury Secretary Scott Bessent says it's all under control. China, he insists, will return to the table. They're just waiting for clearer signals from Trump. But let's be honest, there's no evidence for that. None. Beijing hasn't budged. There's no outreach, no overtures, no signs of compromise. Even Japan, which has over a quarter of its GDP tied to U.S. trade, has resisted bending under pressure. The old levers just aren't working anymore. Meanwhile, the U.S. trade deficit has exploded to $122 trillion, a number that would have triggered international alarms just a few years ago. That's a 41% jump from 2021. And it's not just trade. The U.S. net international investment position, the difference between what Americans own abroad and what foreigners own here, has collapsed to negative $26 trillion. That means foreign entities hold more U.S. assets than ever before. America is selling the farm to finance the illusion of prosperity. And still it pretends to lead. It borrows. It prints. It spends. It calls this strength. But markets aren't stupid. Investors, foreign governments, hedge funds, they all know the truth. Strength isn't just about scale. It's about stability. And when the borrower looks less stable by the day, the lender starts asking uncomfortable questions. In May, the reckoning began to show. U.S. Treasuries, long the bedrock of global finance, recorded their first monthly loss of 2025. Returns dropped 1.2% across all maturities. Long-duration bonds, once the surest bet in the financial world, have now suffered over 7% in cumulative losses since 2020, even accounting for interest. Regional banks are choking on paper losses, $413 billion worth, according to the Fed. That's not a small bump. That's SVB-sized vulnerabilities multiplied across the system. As foreign appetite for U.S. debt shrinks, someone has to pick up the slack. That someone is increasingly regional banks already loaded with risk they can't afford. If they're forced to absorb even more Treasury issuance, they face an impossible choice. Mark their losses and risk a solvency crisis. Or pretend everything's fine and hope no one looks too closely. Either way, confidence teeters. And now Washington wants to squeeze even tighter. Buried in Trump's newly proposed Big Beautiful Bill is Section 899, a provision so vague and sweeping it could act as a backdoor capital control. It empowers the U.S. Treasury to unilaterally impose taxes on companies or investors from any country deemed to have unfair foreign tax practices. That determination? Completely subjective. At Treasury's discretion. Analysts at J.P. Morgan are warning, this could hit countries following OECD-compliant tax structures. Allies like France or the UK might be penalized under rules that were never supposed to apply to them. And the timing? Couldn't be worse. The U.S. needs to auction off roughly $300 billion in new debt this quarter, according to the CBO. But foreign participation in bond auctions has already dropped, from 72% a year ago to just 57% today. That's not a blip. That's a warning. If you threaten foreign investors at the exact moment you need the capital, don't be surprised when they disappear. If capital fears it could be trapped, taxed, penalized, or frozen, it won't just pause. It'll flee. When the world starts treating the dollar not as a safe haven, but as a risk zone, everything changes. What was once a magnet becomes a quarantine. The Geneva Truce, the supposed reset between the U.S. and China, was meant to cool things down. It hasn't. Nearly 3 weeks later, Beijing has not rolled back its rare earth export restrictions. Trump, meanwhile, is back on the offensive, threatening new auto tariffs on Europe. And Besant's promise of a Trump-Xi call remains just that, a promise floating in air. No confirmed dialogue. No date. No progress. Back home, demand is sagging. Inflation remains stuck at 2.3%. Treasury auctions are thinly bid. Banks are quietly absorbing more and more risk. And in the background, the geopolitical tension keeps rising. Visa revocations, export bans, military posturing. Trade is no longer just economics. It's a battlefield of values, narratives, and control. China's Ministry of Commerce is now demanding that the U.S. correct its wrong practices. That language isn't diplomatic fluff. Historically, it's been a prelude to hard retaliation. Tariffs, sanctions, regulatory crackdowns. This is no longer just a trade dispute. It's a systemic decoupling, one where ideology, not just economics, drives the choices. And the U.S. right now lacks both trust and leverage. So here we are. The edge. A fragile truce fraying by the hour. A currency whose supremacy is starting to slip. An economy still pretending it can power through. Treasury auctions that are missing buyers. Consumers pulling back. Foreign capital tiptoeing toward the exits. And Washington? Still charging forward, blindfolded. Threats in one hand, tariffs in the other. Pushing policies built on assumptions the current data flatly rejects. So here's the question. The one that matters now. If China won't bend, if foreign investors stop showing up, if American banks are forced to take on more risk than they can even value, what breaks first? The bond market? The dollar? Or the illusion that anyone is still driving this machine? Let us know in the comments. What happens if this standoff isn't just a passing storm, but the new climate? And if you found this valuable, hit like, subscribe, and check out the next video. It's already live and connects the dots even further.